I think that we're probably looking at levels, and again, as the World Gold Council, we're careful not to call the price. We have a view on demand trends, and that's really where we spend our energy and our focus. But there are industry professionals, Goldman Sachs, for example, putting a 3,100 level out. I think others are reaching for 3,450, et cetera. I think what we need to see is a next catalyst for the market to really kind of make a big move up forward. And I think that 3,100 level is probably the one that for me is most interesting. If we reach that number and we reach that number before the first half of the year, that'll be actually a really strong performance for gold. That might be the next resistance level that could develop over the next 6 months. And I think that really that'll be putting us up near 20-25% return on gold year to date, which is actually pretty extraordinary in terms of what we're looking at.
Gold's rapid ascent has positioned it for potential price consolidation, but despite short-term fluctuations, its long-term trajectory remains robust. Analysts emphasize that fundamental factors will ultimately determine whether the rally can sustain its momentum. JosephCavatoni, senior market strategist at the World Gold Council, highlights that gold's upward trend remains intact, with key resistance levels projected at $3,100 and possibly $3,450. Notably, there are no significant downward pressures weighing on gold, reinforcing its appeal as a hedge against economic uncertainty. A recent report by the World Gold Council notes that gold has historically remained above each new $500 per ounce increment for an average of 9 days before experiencing a pullback. However, in 4 out of 5 instances, gold rebounded above these levels within just a few days, demonstrating its resilience in maintaining a bullish trend. From a technical and market positioning perspective, sustained gold prices above $3,000 per ounce over the next 2 weeks could trigger further buying, particularly in derivatives markets. Currently, an estimated $8 billion in net delta-adjusted notional value in options contracts from U.S. gold ETFs is set to expire on March 21st, with an additional $16 billion in options on gold futures expiring on March 26th. This could lead to a slingshot effect, driving prices higher, but may also result in short-term profit-taking as traders capitalize on recent gains. Beyond speculative trading, institutional demand for gold remains robust, particularly in China. Cavatoni notes the Chinese government has approved its top insurance companies to invest in gold, signaling a broader shift toward gold as a strategic asset. This move aligns with a growing trend where demand is shifting from traditional jewelry purchases to investment-driven acquisitions. TD Securities notes that the Shanghai Gold Exchange has admitted 4 major Chinese life insurance firms as members under a new pilot program. This development could significantly boost institutional gold demand. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I think that we're probably looking at levels, and again, as the World Gold Council, we're careful not to call the price. We have a view on demand trends, and that's really where we spend our energy and our focus. But there are industry professionals, Goldman Sachs, for example, putting a 3,100 level out. I think others are reaching for 3,450, et cetera. I think what we need to see is a next catalyst for the market to really kind of make a big move up forward. And I think that 3,100 level is probably the one that for me is most interesting. If we reach that number and we reach that number before the first half of the year, that'll be actually a really strong performance for gold. That might be the next resistance level that could develop over the next 6 months. And I think that really that'll be putting us up near 20-25% return on gold year to date, which is actually pretty extraordinary in terms of what we're looking at. But again, right now, we don't see a lot of factors on the horizon that are looking to put downward price pressure on gold. That's, I think, the most important thing that we can share with people is the case remains very strong for global investment, very strong for central banks, as I've said repeatedly. But then again, consumer side really having less impact on the price, less impact on demand. So let's see how that starts to develop. Well, I think China remains strong in terms of their involvement. I think also Poland and other nations are actually out in the market making purchases. I think Bolivia is also another nation that's actually talked about adding gold to their reserves. But I think it really continues to be an emerging market trend. I think it continues to be pretty wide ranged in terms of those that are continuing to be active. And actually, interestingly enough, we're seeing some that are actually talking about making use of their gold reserves to also just ensure that they have the right kind of economic conditions on shore. So right now, I think that the trend is continuing to see that these banks are actually purchasing, stepping in and buying. The Eastern developing nations are definitely at the game, but they're also reporting, which is actually encouraging because sometimes they may choose to not record or they may not necessarily report in a timely fashion. But I think that signal alone tells us that they're comfortable and they're actually very active in their involvement. higher prices tend to pause purchasing with respect to consumer spending on the jewelry side. And actually, we should qualify that there's retail demand in the form of bar and coin, which actually is interesting for us to watch and keep a close eye on as well. But as it relates specifically to jewelry, for sure, higher prices tend to be stop the purchasing, and then the next move is actually look to move into recycling. Something we've already seen. It developed into the fourth quarter and throughout the course of 2024. Not going to be surprised if we see that trend continue into the first quarter. And it's kind of signaling what we've been hearing so far, particularly in two markets, China and India. But again, those markets are moving not only in the jewelry space, maybe a little bit of a slower demand, but they're moving more along the lines of into more of an investment demand that's picking up some of that slack. So again, we're keeping a close watch on how much slowing we're seeing from jewelry, how much that's making its way into the recycled supply channel, and how much demand is picking up in each of those markets. An interesting soundbite for China is that they've recently announced that the insurance companies, 10 top insurance companies onshore, are permitted to engage in a pilot program of investing in gold. And 4 of those insurance companies had actually just announced that they've gotten membership at the Shanghai Gold Exchange, which is super exciting stuff. So you're looking at a shift from jewelry being the real key driver. And now you're looking at investment really taking on a lot more momentum. So you have to keep both in mind. Again, slowing in jewelry, hand in pocket buying less jewelry, hand in pocket saving a little bit more. I think we need to see something very definitive coming out on the impact tariffs and the U.S. economy. I think that those monies that are coming in the form of ETF flows in the U.S. are giving us a signal that investors are back to the game. I'd like to see a little bit more clarity around how the economic conditions are going to develop, not only domestically in the U.S., but how it's going to impact trade and the economies that are heavily reliant on it, Europe and the UK in particular, and actually see what that can mean for the outlook for risk assets and actually really how much flow is going to continue to come back, not only in ETFs, but in the physical market, the OTC market, which we know is much more substantive, but actually trades OTC. So it's a little harder for us to see it until the end of a quarter.
JosephCavatoni notes that while tariffs may not directly target gold, it could still be affected as part of broader trade measures. Investors are closely watching for clarity on how tariffs and the Federal Reserve's stance on rate cuts will shape the economic landscape. The escalating trade war, particularly under Donald Trump's policies, has raised concerns about America's economic stability. Moody's, a leading credit rating agency, warns that tariffs will weigh on business investment, dampen consumer confidence, and limit the Federal Reserve's ability to cut interest rates. Additionally, the agency highlights that the affordability of U.S. government debt is now materially weaker than it has been over the past 2 decades, making it worse than other high-rated economies. Further complicating matters, Trump has indicated that value-added taxes and digital services taxes imposed on major tech companies will be factored into trade assessments. This has left key U.S. allies, such as the UK, scrambling to adjust their policies to mitigate potential trade tensions. The UK Treasury is reportedly exploring ways to modify its digital services tax to align with U.S. demands and secure a favorable trade agreement. Let's get back to the interview.
Everything we're saying about tariffs not necessarily being the target of gold or gold being the target of tariffs. What I can say is that whether they come down or not on April 2nd and they are broad-based, gold will get caught in that net like everything else. So again, the futures market in the U.S. is a market that has to rely on physical backing and an opportunity for that physical delivery to take place at the expiry of a particular contract. Therefore, those that are trading over dates that are critical, futures contracts go out 30, 60, 90 days. Those that are trading for longer periods of time need to ensure that if they have a risk or an opportunity to deliver the physical, they need to have it in New York, and that way they can price the instrument and the trading that they're doing appropriately. So continue to see those flows come through until there is absolute clarity on exactly how tariffs will play out. This European deadline of April 2nd, very important. That's why you're seeing the flows coming in still. But I think ultimately it's coming in at a slower pace. Again, people are getting their head around the fact that we're not necessarily the primary target. However, still important to make sure that your risk is managed. Therefore, the gold needs to continue to come to the U.S. market. So expect it to continue. I think it's coming in at levels, at paces that are slower than what we may have seen in the earlier stages of this phenomenon coming into play. So I think it's definitely continuing, but I think it's coming in at a slower pace. Risk abounds, and investors are actually at the point where they're saying it's time to put money back in risk protecting assets as an allocation of our portfolio, including in the U.S. market. So of the 19 billion roughly that we've seen, about 12 billion has gone into the U.S. But again, we're seeing flows in Asia and flows in Europe. Also, people understanding, investors understanding it's time to continue with the allocations to maybe look to increase which is what is new for us this year. Over the last few years, we felt that most investors were holding allocations for gold. I think the risks are high enough now, and they're understanding that the economy is looking to be maybe stalling a bit. And I think that they're looking at gold as that hedge that they need back in their portfolio, whether it's for inflation purposes or risks that just continue to put shocks to the system. If you just look at what we've seen in terms of risk assets over the last 2 weeks, really exciting, but really risky and really moving fast and actually having something that holds its value. Gold's performed exceptionally well when we've seen risk assets coming off, whether it's equities or whatever the case may be. And you actually can use that as your safe haven, buffer that bit of risk in your portfolio, but also use it as your cash pool for a quick move when you want to buy a dip. So I think it's actually front and center for people. And I think that the allocations look likely to continue over the course of the year. I think that Europe will probably pick up pace over the next 6 months as well in terms of the ETF flows. With tariffs, with the changes to the economic outlook, that maybe this is a time for a weaker dollar. Maybe this is a time for a weaker U.S. economy. The numbers that we're getting out right now are actually signaling that may be the case, but they aren't necessarily the key critical data points that we want to keep close watch on. I think right now people are trying to assess whether or not this strategy that the administration is using will be good or risky for the economy. And I think we just had a Fed that came and went with respect to a rate cut potential. They didn't move. We don't expect them to move. Now they're signaling maybe even less than 2 cuts, maybe 1 cut over the course of the year. So I think what we're watching carefully is what this implication will be on the economy for the U.S. I think that's why the U.S. are leading, and I think that's why Europe will probably be looking at it next and make additional allocations to gold to manage risks that are going to potentially develop in their region as well. I think it's a really interesting point, and I think what is really critical for people to take into this consideration is that when allocations are made, they are made on the basis of how much percentage of portfolio should I basically put to work. So I don't think people are hung up on the fact that 3,000 has been reached and therefore they can't move beyond it. I think investors are saying, what's the right percentage from my portfolio? I think why they're asking and what they're looking at and what they're trying to gauge right now is that we're really up almost 15% year to date. Is there more headroom to go for gold? Will it continue to be continuing to raise in terms of its overall performance year to date? Will it continue to rise? And I think that the case remains strong. And that's the messaging we've gone out with, which is investors are continuing to see the value. Central bank paces of gold purchases are continuing to remain strong. We'll have more color when we come into the end of first quarter and we get our demand trends report out on what's happening on the consumer side. Probably looking to see that continue to wane a bit in terms of China, India, and global demand for jewelry. But again, these 2 key case studies or these 2 key use cases for gold investor and central bank flows continue to push the price higher. So like you said, while we might hit a bit of a flat spot on the price right now, the case remains strong for it to continue to be strong. So I think people are looking at the price that way. So we're through the 3,000 mark. We look like we're staying there. And I think at this point, we're now talking about what's the next level and how much more appreciation can the asset garner in terms of the look forward.
As global economic policies remain in flux, gold continues to serve as a crucial safeguard against financial instability. The combination of shifting trade dynamics, institutional demand, and market-driven momentum reinforces its role as a long-term asset. While short-term fluctuations may occur, the broader trend indicates that gold remains a preferred investment choice for those seeking stability in uncertain times. With increasing economic pressures and policy shifts, could gold's rising demand signal a more profound transformation in global investment strategies? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.